If there was a 70% chance of anything affecting your retirement well-being, would you try to protect yourself against it? Well, unfortunately, if you are 65 or older, there is such a threat that exists out there, and that is long-term care. So today in our financial freedom video, we're going to talk about how you can kill two threats with one stone, so stay locked in. Hi, my name is Carson Graves, Certified Financial Planner and President and CEO of the Retirement Education Center.
And my name is Andrea Graves, Director of Operations at the Retirement Education Center. And we want to thank you for tuning in to our Retirement Education Concepts videos. These videos were created to help to make the difficult and confusing retirement process simple.
Yes, absolutely, because with so many retirement strategies out there and so many retirement concepts, and of course with so many different retirement products, it can become very difficult for consumers to digest it all. That's why we are so fortunate that we work with a team of expert advisors to help us build a financial roadmap that's going to let our clients know when, where, and how they can reach their retirement goals.
For additional concepts on how to maximize your retirement, please subscribe to our YouTube channel and hit the notification bell to be notified when we upload new videos. Carson, the threat of long-term care is so real because we've either dealt with it with our own parents or we've seen our parents deal with it with their parents. So why do so many people leave this out of their retirement planning?
Well, Andrea, I can tell you that unfortunately it's due to a very common human fallacy that we all have, and that's what I call kicking it down the road syndrome. Now, when it comes to kicking things down the road, what it tends to do is just end up costing us more later. Now, I always tell people you should consider nature, right? Let's consider the ant. Ants do not prepare for their winter in the winter time. They're going to prepare for winter in the summer, because they understand those are the conditions that are conducive for them to actually prepare for a long winter when they cannot get out and start gathering food. So the same can actually be applied for us as humans. We should understand that when it comes to a major expense for our retirement, like long-term care, we absolutely cannot wait until it's time for us to need long-term care in order to try to pay for it. We need to have prepared for this in a season in which we were actually in good health and had the ability to actually cover for this expense. And so today we are going to talk about how you can do this in a very smart and cost-effective way. But before we do that, there are always two rules to retirement income that we like to give you. And Andrea, what are those two rules?
Well, rule number one is to never run out of money, and rule number two is to never forget rule number one.
So let's go ahead and jump into our lesson today and talk about how life insurance can help protect you against a long-term care expense.
Carson, a common concern for many of our clients is a potential depletion of their assets and not having an inheritance for their estate due to long-term care expenses. So how can long-term care coverage alleviate this fear?
Well, that is a very good question, Andrea. But I can tell you, first and foremost, we need to address the word fear. I know there are a lot of affirmation pundits out there who will lead you to believe that fear is not real. It's just a figment of your imagination. But I can tell you that fear is very real. And we should always make sure that we don't ever take any blanket statement like that at face value. Of course, we know that some fear is not healthy, but when you have knowledge, real knowledge of a potential threat, the fear should definitely be fully respected. Many of my clients have absolutely seen their own situation get affected by a long-term care event with their own parents. So their parents may have had a nice estate that they were planning to leave to them and their grandkids. But due to poorly funding a long-term care plan, they ended up having to maybe liquidate the estate by selling their home, of course, spending out a lot of their retirement plans that they may have been planning to leave to their kids or grandkids. And unfortunately, when they passed away, they really didn't have anything to pass down to their estate. Now, that is not the position that, my clients want to be in. And therefore, this fear is something that we are always having to discuss with them and giving them avenues of how to protect themselves from it.
Carson, in my past profession, I knew many people paying for regular private long-term care insurance rather than paying for life insurance with long-term care coverage like you have your clients doing. So why is that more efficient for them?
Well, Andrea, I think that is an excellent point that you're making from your previous profession, because I think that's a point that needs to be made in why we think a life insurance long-term care combination type product would be a very efficient way to solve for our clients' long-term care needs. Now, many people may not be aware of just how versatile life insurance can be. Most of us are looking at life insurance for a death benefit only, but life insurance can have many, many different roles. Life insurance can be a very, very important role into your estate, because when you pass away, if your estate is very illiquid, life insurance can actually provide liquidity to that estate. And if you're talking about a tax situation, we know that life insurance, when you pass away, can come to your estate tax-free. Along with that, life insurance can also be a great savings tool and a tool to help supplement your retirement income. Now, Andrea, with you bringing up that particular scenario, I can really shed some insight to this subject matter. I just recently did a review with one of my clients who we put in place 10 years ago a traditional long-term care policy. But unfortunately, that long-term care policy is now increasing their premiums. And I'm not talking about just a little bit. We're talking about a 25% increase in her premiums. And we don't know when or if that's ever going to stop, because that is one of the negative factors when it comes to paying for private long-term care insurance or regular long-term care insurance. Those premiums can continue to go up, and we don't have any idea when they're going to go up or how much they're going to go up by. But in this situation, fortunately for my client, she had done a very good job of saving money over the years. She had saved quite a bit of money in savings. So we were able to extract some of those dollars from her savings and put that into a life insurance long-term care combination type product. So what did we end up doing? She no longer has to worry about her premiums going up, because in those type of policies, your premium dollars are going to stay the same. If you do a lump sum into the policy, Andrea, that's it. That policy is going to be there for her forever. If you're paying monthly premiums into a policy like that, those premium dollars are never going to go up. Another big fallacy with a traditional long-term care policy is that what if you don't use that policy? Well, in most cases, that money will never see your estate. It's going to go to the insurance company. Now she's in a position to where if she passed away and never had to use her long-term care, she would have about $300,000 that would go to her estate tax-free. But what if she never even used the long-term care? She was living too long and never saw a need to actually have that death benefit go to her estate. She can always get back the money that she put into this particular policy. The best case scenario, if you cancel a regular long-term care policy, Andrea, is that you can use a non-forfeiture option to where you can at least use the money that you paid over the years. So if you paid $20,000 into that policy, you can use at least $20,000 for long-term care benefits, but that's it. If you passed away, that money does not go to your estate. But if you're using a hybrid life insurance long-term care type policy, if you pass away, if you actually have a long-term care expense, or if you no longer need the policy altogether, either you or your estate will always be able to reap the benefits of that particular policy.
So Carson, why are more people now getting more interested in long-term care protection?
Well, one of the main reasons I believe that more and more people are getting interested in long-term care is that millions upon millions of baby boomers are either in retirement right now or approaching retirement years, Andrea. And with that being said, as I mentioned before, many of these baby boomers have seen this type of act play out already with their own parents and are simply trying to make sure that the same fate is not going to fall on their family or their estate. And when you consider the annual cost of long-term care, which can range anywhere from $54,000 a year to as high as $108,000 a year, many of my clients are simply trying to make sure that they at least have some sort of plan in place to protect themselves and their estate from falling into the same situation as their parents.
Well, Carson, there has to be some drawbacks because I would think that this would be a no-brainer for people to do.
You know, it would be a no-brainer, but there are two drawbacks that people should be aware of. One, Andrea, is that you absolutely have to qualify for this. So you have to be healthy. You cannot just get a life insurance long-term care hybrid policy without being in good health, which is why we are highly encouraging people that you want to plan now and not kick this cost down the road later when you possibly could be in ill health and can no longer be able to even afford or qualify for this type of policy. The second drawback to this is that you do have to have resources. Now, when I spoke about my client being able to transition out of a private, regular long-term care into a hybrid policy, yeah, she had the funds to be able to do that. So you really do have to have some sort of resources, or you have to have good income in order to make sure that you can afford to pay for a plan like this.
Okay, Carson, what is the moral of this video?
Well, Andrea, I would say that the moral of this video is that we should not be kicking a cost like long-term care down the road. If you are in your early 60s, you absolutely should be talking to a qualified advisor who can help you understand a policy like this and help you figure out what is the best option for you.
Well, Carson, this is extremely helpful, so thank you for your insight on this topic, and thank you for watching. And if you felt this information was beneficial, please like this video and share with others.
Please understand that these videos are created for educational purposes only, and that you should always reach out to your own financial advisor, your own tax advisor, and attorney regarding your personal situation. Also, if you are looking for an independent fiduciary advisor to help you with these types of complex financial matters, we highly recommend that you utilize the links in our description below and go ahead and schedule a 1-hour free consultation with us today.
After this video, please check out our other videos that will give you tips on how to maximize your retirement. And if you like this video, please give it a thumbs up, subscribe to our YouTube channel, and share it with a friend. Thanks for watching, and remember, if you have questions,
we have answers.